Hello, this is June the 3rd, and this is another episode of Two Great Beards. What happened last week? What shall we talk about?
Well, I guess the big thing is the debt ceiling passing. That's been all the talk for an extended period of time, though it seems to me it was always going to get resolved. It actually got resolved cleaner than I expected. And what's truly amazing to me is how little it means.
Yeah, I mean, let's face it, it's so backloaded. And the only thing that is relevant for 2024 is that it's going to be a drag of about 50 basis points on GDP. You can argue it's 30, you can argue it's 70, let's call it 50. But what I'm trying to get across is that it's a minimal drag on 2024. And what's going to happen after 2024, who knows? It's going to be
Right,
a new
exactly.
Congress, a new president, a new everything. So, really, the only relevant thing is that it's a very, very small drag for next year.
Right. And so then you look at the data, and the data was consistent and strong. Jobs reports strong. The NFP had, it had a headline for everyone, but you can't walk away from the data and say that the economy is weak. You can only walk away from the data and say the economy is strong, despite the 3.7% unemployment rate, which is a pretty wonky and volatile rate, in line with expectations. Wages, which gives the people that think that inflation is going to continue to magically come down, some headline, but by and large the number was strong.
Absolutely. No change in economic numbers, nothing to make you think that the economy is going to be weak at any stage soon. And really, that leads us on to what are the effects of the debt ceiling, because I can't see that there's anything that's going to come out of this that is not a great big drain on the liquidity that's available to the market. What do you think?
Right, that's a complicated subject, but without a doubt, you look at the numbers, it's a pretty straightforward numbers. Currently the treasury has already announced their schedule for issuance. The total amount they have to issue is 250 billion to pay back the Fed for quantitative tightening as they reduce their balance sheet, 500 billion roughly for funding the deficit. And they also have announced a desire to, by September 30th, have a checking account, the TGA, which is back up from 50, where it is now, to 600 billion. And so you add all those numbers up, you get a number like $1.3 trillion. And that has to be issued in the next 4 months. But it's going to be very interesting to look at. And we'll talk a little bit about that. But I guess the first thing to mention before we go on to, the actual issuance next week is that 400 billion of coupon issuance has already been announced by the Treasury, and they like to not mess around with that schedule very much because coupon long-term treasuries, people need to plan to invest in those, where the bills market they can, buy fairly easily. So 400 billion is the number. Could it be 800 billion? No way. Could it be 450 billion?
Yeah.
Possibly.
Yeah. But it's not going to be relevant. So the only question really that is in my mind is where is this, and whether we say it's half a trillion or three-quarters of a trillion in bills going to come from? Who is going to buy it, and what are they going to use to buy them? Because bought they will be. So it's a
Right.
question of is the RRP going to be drawn down, or is it mostly going to come from the banks, from the reserves? So that is the big question in my mind, and I think the answer is it depends on the yield,
Right.
doesn't
So
it?
let's talk about that and what we're looking at for next week. But what do you think about, what we saw in terms of markets last week was equity markets overall rallied, led by the Russell actually by the end of the week. S&P was up 1.75%. Bonds, gold, the short end of the yield curve, commodities, they were all pretty flat. So it's really just an equity story. What are you noticing in equities?
Ha. Well, I noticed two things. I noticed that the technology sector is losing its leadership overall, and I've noticed a technical doji in the XLK, which basically means that it opened, went up slightly, and closed exactly where it opened, more or less, which is a sign of indecision, which is not surprising after so many weeks of the technology sector being a leader. But what did surprise me is that so much is being made of how everyone's buying technology stocks, and the price actually last week did not change.
Yeah,
At first, a slight shift in the market psychology. I think people are taking profits at these levels, and I think that that certainly makes sense. So there's rotation for sure. There's rotation out of things that went up the most, the things that went up the least. Is that bearish for equities? I don't particularly think it's bearish for equities. I think we're about to see more of a rotation out of tech and into things like XLF or even the regional banks for reasons that we can discuss. But that is all I've noticed.
sure. So, what are we looking for next week?
Very light on data. All we have really is services PMI and ISM on Monday. After that, nothing until Thursday when we get the usual unemployment numbers. But the interesting thing is precisely that we are running out of data that can influence the Fed's decision on June the 14th. All we have is literally CPI on the 13th while they're in their 2-day meeting. And that is what is troubling, I guess, the bond market, because it's saying that the odds of the Fed being on pause are almost zero. The question becomes, are they going to skip a meeting and then raise in July? Personally, I think those are not great odds to play. I would go still for a hike in June rather than July, but certainly for a hike in either June or July, and the possibility of a hike in both June and July.
Right. I agree with that. You had lots of chatter last week that affected the short term bond market quite a bit, with two of the governors, Jefferson and Harker, talking about how they'd be comfortable with what they called a skip, which what they are trying to do, they talk too much, but what they're trying to do is prepare markets for possibilities. And the idea of a skip, they're trying to describe that differently than what they have used in the past called a pause, meaning a skip just means we're hiking another again, but we may skip this meeting versus this, again, it's all just garbage wordsmith and you just should focus on the data. But the idea of a pause means it could be followed by a cut. And so they're trying to add this language. The data's strong. If CPI is strong, I agree with you. And by the way, that's next week, not this week. They're going to hike 25. OPEC speaks this today, tomorrow.
Yeah,
And
but
so that could
yeah,
always create
Sunday,
some
tomorrow,
vol.
and that could be, we have no idea what they're going to do, whether they're going to cut or keep the existing production schedule, but we shall see. What could happen. I mean, oil, we don't know. I don't think it's something that we need to speculate about. If there's something that comes out of it that we think changes the perspective, we'll advise you. But for now, even if oil went up two, three, four, $5, I don't think it changes the story at all. If anything, it makes nominal bonds even heavier, and they are heavy. They're heavy already. So it doesn't change the overall perspective.
Right. So let's talk about the bills issuance. So, as I said, they have to issue $900 billion in bills over the next 4 months to achieve their targets, funding the deficit, paying back the Fed, issuing the coupons they plan on issuing, and raising the checking account back to a level they think is sustainable. That starts next week. As soon as the president signs the bill, the floodgates open. And on top of what So they auction anyway, even when the debt ceiling wasn't being hit, because every day a bill comes due and needs to be refinanced. So the numbers that have been announced for the Monday and Tuesday auctions are quite large, hundreds of billions of dollars. And yeah, the most important thing in a week that's otherwise light of data is going to be the rate those things clear the market on. And I just want to start by saying the last month, there's been a lot of very poor bills auctions with rates, approaching 6%. The reason why those auctions went so badly is because the debt ceiling hadn't been
Yeah.
resolved. And they didn't know whether they were going to get their money back on time. So people stayed away. Quantities were actually extremely low because of the debt ceiling. Now we have the credit risk of the government gone. Now it's back to riskless. And so before all this debt ceiling issue became a concern, bills traded at a significant discount to the expected path of interest rates. And so let me just step back a second and say the expected path of interest rates is already assuming a significant amount of cuts. Now that's changed. People are starting to accept higher for longer, and most of the cuts are no longer in 2023, so are not going to affect the bills market. But the thing to watch is who buys the bills? What is their source of funding? And there are only two possible sources of funding for bills purchases. One is bank deposits, and
And
the
the
other
RRP.
is money that is currently deposited at the Fed in the reverse repo program, RRP, that money market funds have invested your money in. And so either the money market fund has to withdraw money from the Fed, that the RRP program, to buy the bills, or you have to withdraw from the bank to buy the bills. And the former doesn't really hit the economy particularly, and so is quite attractive to markets. And if it were to happen, is quite attractive to markets, but not particularly attractive to the bond market. Meaning, in order to withdraw the money from the RRP, the rate has to be very high because the RRP is already getting 5.09%, and by July is going to be getting 5.3%. And so buying a bill has to happen at a yield high enough to attract the money market funds to withdraw. The alternative is that that rate isn't high enough. Well, that means there's demand coming from someone, and that demand has to be coming from bank deposits. And that withdraws liquidity from the economy. So, to sum that up, if the RRP, the bills auctions that we see in the days to come, happen at a rate that drains the RRP, that means there is not a lot of demand for 2-year notes. The yield is high. And so 2-year notes should suffer in that case. Alternatively, if the rate is below the RRP, and that means there's quite a lot of demand for bills coming from the banking system, that means people don't want stocks. And the banking system will struggle to provide credit because they will have lost these deposits and their accompanying reserves. And so that's negative to equities. So that dynamic is pretty important to watch in the days to come.
Absolutely. I completely agree with you. I think that there is a very good chance that bills go over RRP. And, that is certainly going to be negative for risk assets. And that is what I actually expect to happen over the course of the next couple of weeks. The risk assets have had a very good run, and I would urge anyone actually who's participated to a great extent to actually take profits. Last week I said basically that QQQ is going to go to, 63, 65, still that view, but we are getting to the top of the range of asset values here. We are very, very rich. And if this issuance goes the way we are talking about, that the bills could easily go over RRP, that is certainly going to hit the front end of the curve and certainly the belly of the curve. So twos, fives, maybe even tens start giving up. And if that does happen, you will see a lot of pressure start to come in at the current valuations in risk assets. So I think that we are certainly going to be in a period of very little upside compared to the risk of the markets giving back quite a bit of what they've gained in the past couple of weeks.
Yeah, right. If RRP gets drained, that means yields are higher, and that takes away some of the multiple of equities. If RRP doesn't get drained, that means banks suck liquidity out of the financial system. That's tough for assets. It's a tough situation given what's coming. So, we have a defensive portfolio. That defensive portfolio doesn't have a lot of exposure to the high flyers, but most of you all have a more diversified portfolio that's potentially less defensive. And to me, Nick's been right on playing this from the long side. To me, it seems very clear that if you step back over the course of the year, it's time to lighten up some of your equities, stay away from nominal bonds, which we continue to dislike strongly, and, opportunistically start lightening up equities going to cash.
Yeah, absolutely. I think the odds. Let's talk about a little bit about what the yield curve is doing and why we are still so defensive on nominal bonds. All the data that's been coming out suggested very strongly that we should be in a strong period of bear flattening. What do I mean by that? That all rates should be going up. That's the bear bit. And the flattening is that the short end should be going up more in yield than the long end, i.e., the twos should be going up in yield more than the 30s or the rest of the curve. And that's the way I've been playing it and having very, very little reward, even though I get in at very good levels. So basically, what is happening is that we're getting a parallel shift, what we call a parallel shift, i.e., the whole curve is moving more or less in unison, although at different times. But net over the course of the week, if twos are up 10 basis points, 30s are up 10 basis points as well. So the net move is almost zero. You get the opportunities in the meantime. But that tells me that there is very little long-term demand for bonds at these yields. Because if twos cannot outpace 30s, that is a bad sign overall. It's a sign that the market does not expect that inflation will fall enough for the Fed to be able to have a positive enough yield curve, in the end. To me, this is a sign that the bond market is still in a defensive posture, and it will continue to be in a defensive posture until we see the economic numbers turn. And we're nowhere near that. And if we can't buy bonds, then at some stage, the risk reward of buying equities at these valuations has to change.
Yep. Completely agree. So, has your macro outlook changed at all?
Nothing at all. Higher for longer. As I said, bond yields are still heading higher. It might be at different speeds, but we've seen nothing to change our outlook or that the idea that we're getting to levels that are where you should lighten up on risk if you have it.
Yep. Agreed. So, what about the portfolio?
Our portfolio is defensive and we are at 25% in equities. I would take it down. I would leave an offer in what we have. We have the Dow, although I don't think the Dow is going to be the problem. I think the higher beta stuff is going to be much more of a problem, but I have no problem taking, given our view of what is the issuance that is going to happen over the course of the next quarter. The fact that I think that the bills are going to have to trade over RRP, I have absolutely no compunction going down to the lowest risk, and that is 20%.
Okay.
So I would sell some Dow slightly above the market. If they want them up there, they can have them.
Sounds good. See you next week.
We didn't do anything last week, so these are still the allocations. The order entry is very simple. We have cancelled the TLT bull spread, which we were selling, which did not get filled, unfortunately. But this is the only order then. We're selling the Dow at a limit of 343 in 30 lots to take us down to the minimum equity allocation of 20%. If they want them at that price, they can have them. As we explained, we think that the risks of the bills going above RRP are significant, and also that should influence, while especially the short end of the bond market, the whole of the bond market, up in yield. And therefore, we think that the risk in having certainly high beta assets is at the moment far outweighing the potential reward at these levels. I've updated the monthly performance. I've updated the chart pack. So everything is there for you. We are definitely not positive about equity valuations at these levels. And I strongly suggest, and though I've been trading it to the upside with success, these are trades. At these levels, owning for the long term is probably not a very good idea unless you're going to shut your eyes for the next 2 or 3 months, because we think that the odds of lower prices and therefore better opportunities are very, very high.